Right. So let's begin. So before we start, I will just read out the risk disclaimer for today's session. The information provided in this webinar is for educational purposes only and should not be considered as financial advice. The content presented in this webinar is based on information believed to be reliable, but not guarantee is made as to its accuracy and completeness. Pure Prime and I shall not be held liable for any losses, damages, or expenses incurred as a result of the use of the information provided. Trading and investing in financial markets involve a high level of risk, and it is possible to lose all of your invested capital. Before making any investment decision, it is important to carefully consider your financial situation, investment objective, and risk tolerance. All trading and investment decisions are solely your responsibility. Participants should be aware of the risks involved and only trade or invest funds that they can afford to lose. Right, that is the risk disclaimer. All right, story for my starter. Okay, so basically these are the three indicators that I'm going to introduce to you guys. I'm not sure how many of you have come across these, but of course the third one will be more common and then quite famous. And because I remember last week, I cannot remember the name. One of the participants actually requested for want to know more about Fibonacci retracement. So I prepared for it. Hopefully it will help you to understand it better, right? I try my best to do it. Okay, but first two I will just quickly go through because I would say it is like a alternative, like just like what I said earlier, it's just to confirm your thought. When you're in the doubt, when you're in a dilemma, you don't know what to do, like when you already hold a position, especially, and these are the things that can help you to make your decision better. Okay, so the first one will be the on-balance volume, and then after that will be the Haykin-Ashi charting. Okay, let's begin. So what is the on-balance volume? Because we all know when we talk about technical analysis, basically we just talk about the historical price and the volume, right? So we always go for the moving averages when we look at the candlestick, right? Those are the pricing, but then sometimes we just omitted that we shall also take the trading volume into account, which is also very important. Okay, when there's an uptrend, but when there's no or like very low trading volume, then we shall know that this is not a very strong bullish trend, right? And whereas if let's say when there's the bearish trend and then you try to catch a rebound, and then when you start to notice that the trading volume is easing, maybe you think that, oh, maybe then you should know that the bearish momentum is gradually going down, and then maybe potentially they will have a technical rebound coming up next, right? So we always have to take into account for the trading volume. So this is one of the indicator that derive from the trading volume. So what is the on-balance volume is to utilize the positive or the negative flow of a trading volume, and it try to reflect it as the buying or selling pressure. Okay, later on I will tell you the logic behind it, how to calculate it, what's the formula, and then you can have your own understanding whether or not it does make sense to you. If it does make sense to you, you can try it out, right? So this is basically the formula. Okay. Before I talk about the formula, I will have to share with you guys. This is not like 100% reflecting the true picture of a particular things that you are trading. All right. So you look at the formula, you can tell yourself. So basically, how it comes up, if you take the previous obviously there will be like the first trading volume. After that, the next trading volume, you plus the current volume if the price is higher than the previous time frame. Let's take the example of a daily chart, right? So the first day, okay, when like for example a share, right, go IPO is the first day, so the OBV will be 0. So if the next day the share price go higher than the previous day, and then you add up all the trading volume. Okay, and then after that followed by the third day. So if the third day the price drop, okay, go lower than the previous day, it will deduct the total trading volume. So it derives from like this. So basically it means that when you see the price keep going up, and then you add up all the trading volume, so from there you can see how strong the uptrend is. Okay, and then it will form a line. Okay, later I'll show you on TradingView, because you can get it on TradingView. But other than that, other platform that you use for your technical analysis, that I'm not sure. But yeah, I think you can just try like type in OBV or on balance volume. Then you can see whether or not you can get it. So this is the example. So this is the example that maybe you can just go through one by one, and I hope that you can get it right. So this is day one. Okay, it started at $10. Okay, and it closed at $10. So this is the trading volume. So the day two closed at 10.15. So this means that the price closed higher than the previous day. So the trading volume is 30. So you can see over here. So first day, there's no comparison, so the OBV will be 0. But the second day, because we have an increase in price, so we have to add 30,000 of the trading volume. And then guess what? The third day also close higher. Okay, $10.17. So on the third day, the trading volume is 25,600. Okay, so you add with the previous day trading volume, so it will come up to 55,600. Okay, goes like that. And then you can see on the fourth day, it closed lower than the previous day. So in OBV, it will deduct the total trading volume. So you see, deduct. So on the fourth day, the OBV will be just 23,600. Okay, so it goes on like this. Again, fifth day, when it closed even lower and the trading volume is 23, it will deduct again 23,000, and then it will just left 600 of the OBV, right? And then yeah, it goes on. So you can, if you want, you can capture this particular slide and then go back. You can understand it yourself better, right? So let me show you. Okay, this is the GU pair, GBP USD, and then the one that below here is the OBV. So you can go to like some of the asset will be like multiple million, and then some is like 10,000, right? Different, because you already know basically how it derived, how it calculated. So it's like plus minus. If it's keep going up, it keep adding up all the trading volume, obviously it will be, keep higher and higher, right? So, and then also it depends on the trading volume, right? Some of the very commonly traded things, so obviously the trading volume per day will be very high. So let's see, this is like a H4 chart, and then usually how you use it basically is like when you analyzing a trend. So basically it's like when you have you get a support level, you get a resistance level. So obviously, so for example like this one, like when we have a resistance level over here, example, and then when you see when OVV break above the resistance and then keep going up, then you think you will think like, oh, this uptrend will be very, very strong. Okay, but given that, again, I need to stress this again, is that these are all the like a secondary tools. So when you are in doubt, when you don't know what to do, especially when you already hold a position. Okay, so sometime when you hold a long position, let's say for example, and then you come to a point where you start to have a little bit of a technical retracement, and then you're not sure whether or not this is a retracement, or you will go all the way U-turn back to zero. You go your the initial profit will just wipe out and things like that, whether or not you should take profit here or you should hold it for longer. So this is the tools that can help you to make your trading decision. You can tell like, oh, maybe at this junction, then you think, oh, the trend seems to be very strong because it is supported by the trading volume. Okay, so when when you use these tools, right, and then you can have this part of the information. Because if you just look at the candlestick itself, it just show you the the high price, the low price, like the body, whether it's not is the doji candlestick, or it's like a long solid body candlestick, okay, or it's like a red candlestick, where it's a bearish candlestick, or it's a bullish candlestick. Only about it's not only talk about the price, but we don't want to omit the trading volume. Okay, we have to definitely take into account for the trading volume. So definitely OBV will be one of the tools for you to deploy. And then, of course, there will be a limitation for every indicator. So obviously, OBV will have one. So I think for OBV is often used when you have doubt, right? So if you just purely use it for all your trading analysis, technical analysis, it is especially not suitable for scalping, because for scalping, we just want to capture the very short moment of the opportunity. So often we use like 5-minute, 10-minute, 15-minute charts. So and then we just play around with the sentiment, right? We play around with a very short-term trading opportunity, right? Sometimes when it just touches the support level, we want to try to catch a rebound, or sometimes when it touch the resistance level, then we try to catch a retracement. So so at this particular situation, then the trading volume might not be so important, because the shift of sentiment will be like very fast, and then we'll come back to back to neutral. And then so and then another limitation is that it is not 100% reflecting the true story of the markets, right? So because the logic is like this. So when the price is higher, so it add up the total trading volume. So but what if the just sideways, and then it just closed like 1 cent lower, but it will just deduct anyway when there's like maybe the buying momentum is still quite strong, and it's like a huge chunk of trading volume. But if it's just at the end of the time frame, it just closed slightly lower, and then it will just deduct the OBV, deduct the trading volume, so the OBV will just drop. And what if the next moment, the next time frame, it will just shoot up, the price go very high, but then the trading volume didn't follow, right? Then what's happened is you get what I mean. So it's not 100% reflecting the true story of the markets. So I have to keep saying this, like, it's just a helping tool for you to just double confirm the direction of your trading, right? And then so if the third one of if you just purely, because if you just use this as a indicator to make your day-to-day technical analysis, this is not wise, right? So because just purely depends on the trading volume, but you ignore the fundamental factor, you ignore the market sentiments, you ignore any other signal, it will be quite misleading for you. Okay, for example, like if let's say yesterday markets, right, when the dollar, okay, everyone thinks it's going to be strong, right? We have upbeat PPI, and then we have Jerome Powell come up to say something very hawkish, and then you think like the dollar index might be very, very strong. And then maybe if you look at the OBV, I don't know, I'm not sure with the OBV, maybe the OBV also show you that it's a good to go. Okay, if it's a very good chance for you to go for a long position. But then if you ignore the market sentiments, okay, maybe after what Jerome Powell say, after the market digests, and then the market sentiments turn to be quite bearish, and then they want to position themselves, and the market sentiment change, and you just stick to your plan. You will say like, oh, the OVV obviously say go for a long position, then you keep stubborn, stick to it, then it is not wise, right? So obviously the first thing is the market is the priority. So we cannot beat the markets, right? We can only follow the market. So if the entire market have how to say, if the entire market have already picked one direction, then we should just follow. We cannot ignore the greater markets, but just follow our own heart, our own analysis, our own homework. Okay, this is not wise, right? So these are the limitation. Okay, so yep. And then moving up is the Heikin Ashi charting. So this is very similar to the candlestick that we always see, but just that the way they take the closing price, opening price, high price, low price differently. They have their own formula. So for me, this is also not very friendly for people who love to scalp. Okay, it's only when again it's like confirming your trend. So especially if you are doing a swing trade, then I would say this is a very good tools for you to confirm your trend. Okay, especially swing trade, even day trading, because sometimes day trading is not enough. The time frame is not enough for you to use this Heikin Ashi. So you can try it out. Sometimes you can use the scalping strategy, then sometimes you can use the day trading strategy, and then sometimes like for example, now you think like in the longer term gold price might be very very strong. Okay, can even have a chance to go back to the all-time high. Okay, go back to above 2,400 level, and then you want to use a swing trade. Maybe sometimes you can use this Heikin Ashi to double confirm your direction. Okay, so this is the, I think it is a better version of if you compare to candlestick, because it allow you to visualize the trend better, and then from there you can forecast the price movement better. So I'll just show you how it comes up. So it is very similar to the candlestick, right? So you guys remember when we have a candlestick, we will have 4 components. We will have the highest price, we have the opening price, we have the closing price, and then we have the lowest price. 4 things, right? So in the Heikin Ashi charting, you also have 4, but the way they come out with the these 4 components will be different. So it's let's see. So for the opening, right? So it will use the current opening. Current opening is means like the candlestick lah, and then you will take into account of the closing of the previous candlestick, and then it divide by 2. So from there, it can get a smoother representation. Okay, it will like average out the price movement. Okay, and then for the closing is even more complicated. It will take the current opening, current high, current low, and the latest, the closing price, and divided by 4. So divided by 4, only you get the closing price. So high, so how the high level is not the highest level of the current time frame, but it will just pick the any highest level of the opening, the high, or the close. Okay, it will and then the low is the same. You will pick the lowest level. So from there, you can tell it's because it divided by 2 and then it divided by 4. So it like take the average of the price. So it's very a bit similar to the moving averages. Like you divide by the parameter, right? Okay, but this one is divided by other components. But I think the chart is look very similar to the candlestick. But it's just smoother. Okay, I will just show you, and then you can understand it. So these 2 are the same chart, right? These are the US 100, the Nasdaq. Okay, and you can see on the left one will be the candlestick, a very common candlestick, and then on the right will be the Heikin Ashi candlestick. So for you, if you are using the trading view, you can pick it from here. Okay, you can see a lot of other charting tools lah. So Heikin Ashi is one of them. Okay, and then why I say is for allow you can use it better when you using a swing trade strategy, is because you can if I zoom in, you can tell, right, it get rid of a lot of noise. Okay, for example, see this one, there's like a a straight uptrend, right? A straight bullish uptrend, but you see here there's some noise. So for you, if you are not very firm on your belief, right, you're not very firm on what you have analyzed, maybe you can sometimes go to this Heikin Ashi to double confirm whether or not you're on the right track, because sometimes we are just disturbed by the noises and then the candlestick pattern, then you think, oh, this is like a dodgy, well, I think we should TP here. But maybe if you go back to the Heikin Ashi, then it's like a very nice uptrend, and it's like maybe, you know, make you more confident with your trade, make you more confident with the direction that you pick. Okay, it's because it's smoothed up the average of the pricing, so it's better for you. You can visualize the trend better, and I think the most important thing is it get rid of the noise. Okay, so and also you can tell there's also like a tail, right? It's very similar to the candlestick. It does have tail, it does have body. So for what you learn from the candlestick pattern, you know, you can also apply it to this particular charting tools. Okay, because it's quite similar, right? But of course, there is also come with the limitation. Why? Because it's smoothed up thing. Okay, so it's not like 100% also again reflecting the true story of the markets. Okay, because it use the average, and then also it is like a lagging result. Why? Because it takes the previous closing into account, and then it divided, and only it come out with the new candlestick, right? So this means that the charting will be a bit lagging. That's why I say if you love to scalp, if you're doing scalping, then it is because you want it like bam, right on time, right? So it might not be very 100% suitable for you. Okay, only when you are in the swing trade strategy, you want to capture the entire trend, the profit of the entire trend, and then when you are in doubt, then you should can double check with this Heikin Ashi charting, right? And then so obviously sometimes it will create the false sense of the trend strength. Okay. Anyhow, I would say for you guys, right, you can just take the candlestick pattern, just like the ordinary candlestick pattern for your day-to-day trading. Only when you want to double check, double confirm the direction, only you just refer to the Heikin Ashi. So because why? Because if you refer just on the Heikin Ashi charting, then you want to set your stop loss, set your TP, that would be not very accurate, because like the number will be a bit off, right? Because it have the averaging the value already. So the price is not like 100% truly reflect the sentiments or the current price in the markets. Okay, so when you want to again go back, when you want to set your TP, set your stop loss, and you always go back to the candlestick. This is really just help you to confirm your direction. Okay, these are the limitation. So the last one is the Fibonacci retracement. So I think this is very widely used, and I think it's quite famous. And for me myself, I think it is quite interesting because sometimes I get it is like magically get us the correct resistance and support. Okay, so I'll just introduce to you. So this Fibonacci sequence is invented by an Italian mathematician. So from there, people just use it, you apply it in the trading world, in a financial world. So they found that this sequence is coincidentally very matched with a lot of things. When they take our body DNA, and I don't know, like the size of the DNA actually matches with this sequence, and then they see, when they take picture, then they see that this is like a very beautiful, very nice ratio. If you use this very magical sequence, you can get a very beautiful ratio for every picture, things like that. When you do design, I think those design students maybe will also follow this Fibonacci sequence. Okay, but in the financial world, because it is like a nature, it's like the rules of law, right? The law of nature, like the entire world just follow this sequence, right? People things like that. So and trading. So what is trading? So behind every trade, behind every price, behind every trading volume, it is from human. It is from us, from you, right? So we are human. We are part of the nature. So they think that we are part of the, we have to also apply the law of the nature, and they believe that the Fibonacci sequence is the law of nature. So let's see. But I think for me, by far, I feel that it is quite useful and it is quite true. And I think it is like too useful that almost everyone is using it, so that everyone will get the same resistance level or the same support level, and it make it true again. It like make it more true because everyone just follow the Fibonacci retracement, right? So the one that below, or the numbering that below is like to show you how it derived. So it's like very commonly, so you use 0 plus 1 will get 1, right? So when you take 1 plus 1, you get 2. And then you get 1 plus 2, you get 3. You get 2 plus 3, you get 5. So it goes on like this. Okay, 3 plus 5, you get 8. So this is the basic sequence. And the one in the yellow number will be, 1 divided by 1, you get 1. 1 divided by 2, you get 0.5. 2 divided by 3, you get 0.66 something. Okay, it just goes on until here. Why in a Fibonacci retracement, 0.618 is very important. It's a magical number for everyone. Out of all the number, I think 0.618 is the most magical number. Is that after this, all the number that you're going to divide, you will get 0.615. This is like the golden number, Muhammad. It's the magical number. So every time people just follow the number. So after that, people just make more experiments, and then they come up with another magical number, which is 382. This is not 383 typo. Okay, 382. So how it derive is it jump one number and then it divide. So it's 13 divided by 34, you will get 382. And 55 divided by 144, you get 382. And then it just goes on like this, you're still getting 382. And then you guys remember there's another number. So you get 13 divided by 55, you get, I think 25 what? Can I remember? Let me check. Yeah, you get 236. Say it's 13 divided by 55, you get 236, and then you get it 89 divided by another number here, you still get 286. So these three are the very common magic number in the Fibonacci retracement, especially 618. Okay, and then normally how we use it, this is not like for me this is not like where you get the signal. It is for you to find support and resistance level, because we believe in the law of the nature. We believe that in every uptrend, sure, there will come a retracement, and then we believe in every downtrend will come with the rebound. So we want to just to check the resistance and support for every trend. So that's why we use the Fibonacci retracement to get a resistance and support. Okay, so this is I think the most important function for the Fibonacci retracement. So for me, it is not like where you find the trading opportunity. It's for you to find where's the support, where's the resistance. Okay. And then I will just pull up the chart, and then okay, let's see what should we go for. Right, so how we normally use it, right, is like let's say we go for, let's say, this downtrend, and then when there's like a rebound. So we're not sure whether or not this is like a rebound, or don't know how high it goes, or it will continue to drop. And then this is where we can draw a Fibonacci retracement. So normally how we draw is to go, if you go down, right, is to get from the highest level to the lowest level. Okay, you have it depends on you. Some of you guys love to include the tails. Some of you guys just love to just take the body. Okay, if you want to take the body, you will just go until here. Okay, and then the logic behind it is like this. So when if let's say you take this downtrend into account, right? If the trend is like this, you go down and then you retrace, you can see the number over here. So if the first number it will encounter will be the two the 236, right? So if it does got a resistance level over here and then it continue to drop, then this will be a very strong bearish momentum. But if you go another case is like this, you go down and then you rebound and then you resist again at here and go down. So it does just tell you that this bearish momentum is still strong, but it's not stronger than if it's got continue to drop at below 236. Okay, the third one will go to 0.618. So it dropped to 0.618, and if it got reject over here and then continue to drop, then you can tell this is like one of the weakest bearish momentum. It does still go down, but you can tell that the momentum is not strong anymore. But if it does just rebound to all the way across 618, what does it mean? It means that this is really almost 100% to say it is already a trend reversal. There's no more bearish trend down the road. It's already reversed. Okay. So this is something that you can check the trend. So every time when you're going to use it is when there is like when in the downtrend, when there's a rebound, and when there's an uptrend and there's like a reversal. So this is only the time when you can take into account this is when you can use the Fibonacci retracement to check the support and resistance level, to check where you should put your stop loss and resistance. But once again, this is not like the tools that you can find a trading opportunity. Okay, and another very useful tools that you guys can learn will be this trend-based Fibonacci extension. Okay, why? Because we know now, I've taken the example of the gold now. Because above the gold now, there's no more price, right? There's no more historical price, and then you don't know where to refer because it's almost hit the all-time high. Okay, so what you can do is you can use this. We call it trend-based Fibonacci extension. Okay, so what you do is basically you take the low, if it's uptrend, you take the lowest level, go up, and then you take the retracement, and then you draw it. And you can come up with, you see over here, there's more lines for you to refer. So if you, let's say now at the moment you're already holding a long position for gold, okay, this is the gold chart by the way, okay, and then you can refer back where you think it will have a chance to retrace. Or okay, if you think that you're gonna have a retracement over here, then maybe what you can do is maybe you can TP over here, which is at 2390, and then maybe you can get a chance. Maybe you think that if you drop back to 38.2%, which is at 2360, then you can re-enter again if you believe that the uptrend is very, very strong. And this is always like, the Fibonacci retracement level is just for you to get the support and resistance level as a reference, as a guidance for you. And you should know, you can, gauge the strength of the bearish momentum, gauge the strength of the bullish momentum, and from there you can make your trading decision. Okay, so this is the thing. I hope that I can explain it clearly. So this is basically how I use it lah. Normally I will just pull and then I just find the support and resistance level itself. But if you don't use the trend-based Fibonacci extension, basically the Fibonacci retracement itself is very is already very useful, right? Because if I draw this very long-term uptrend, right, I think you can basically tell it is very nicely falls in every every support and resistance. Okay, especially after it break over here, you see that's when I draw this line over here, right? Okay, the first resistance is already at here, and then after that you can see over here there's like almost like a support level over here, which is like 0.5, and then go back up, and then again you come back over here, a resistance, and then a support. It's always almost nicely fall. So it's you can do you can go back and test it out, do a try and error. You can draw in every chart you want, and then you can try it out whether or not to take into account of the tail, or you want to take into account just the body itself. That is depend on you. Okay, you can just try it out, do your homework, and if you think it is like very true for you, and then you can just use it in your day-to-day trading. Of course, it does have some don'ts. Okay, you don't just solely rely on these magic number. Okay, especially the 618 and 382. Okay, this is like not 100%. This is just a guidance for you to get your support and resistance level. Okay, but of course, apart from Fibonacci retracement, you also need to have other indicators to support you, okay, to guide you, right? And then also do not really fit the Fibonacci level, because everyone, I told you everything, every price behind every price is from human. You and I, we might have a very slightly different opinion. Okay, you and I might trade in a different time, trade in a different size. So there is obviously will come up with a very complicated a piece of chart. Okay, so it is like it's a rules of law, it's like a law of nature, but this is not 100% fixed for it. So again, this is just a guidance for you. Okay, you don't really 100% falls into the trap that just die like want to follow the 618, follow the 382, things like that. And then I remember I told you guys that support and resistance, there is not a line. There's only the line when you want to set a TP and stop loss. It often like a thin layer. It's like a zone. It's a layer of support and resistance. So it is the same to go to the Fibonacci retracement. It is not like an exact line. You don't think that when the gold price touch sharply at 2200, this is like a very nice support level. It will definitely rebound from there. No, right? You guys know, right? It will sometimes go down to like 2195 or 2190 only in rebound. Okay, if given that we all know 2200 is a strong support level. Okay, this is the example. Or maybe you will think that 2400 will be the next resistance level. So it is not, I will guarantee you it will not like just touch 2400 and straight away drop. Okay, if it does really the resistance level, it can be like it will drop at 2390, and then it will start dropping. Okay, or it just go break above 2400, go to 2410, only it drop. So this is like a zone where it's the resistance for the gold, but this is not 100. It is definitely not true that the resistance will be a line, like exact line. So the exact line will be just for you when you want to set a TP and stop loss. Okay. So yep, this is the Fibonacci retracement. I hope that because it's a very hard to explain like 100%, but only when you apply it, when you draw. Basically, you just need to know where to draw the first line and the last line. Okay, when you drop the highest level and the lowest level. So when you want to check your bullish momentum, draw from the lowest level to the highest level. And when you want to check the bearish momentum, you want to check the downtrend, you pull down from the highest level to the lowest level of the trend. And also it depends on how big, how long the time frame you trade, and then after that you decide on how long the time frame you want to take into account. Okay, because for example over here, this is like a time span across a month, more than a month. So if you're definitely not going to trade for so long, obviously you're not going to pull a retracement level for this long, right? So maybe you just pull in a very short trend like this, a tiny trend, right? Then for example, this one, maybe I'll just take this away, right? For example, you think you already traded, you already inside here when you pull from the lowest point to the highest level. Okay, very nice. You see, very nice. It does rebound near at 618. This is like really the magical number. And remember that I told you guys when it only rebound at 618, this bullish momentum will be not so strong compared to if you rebound from 236 or you rebound from 382. So you can see now it got a resistance already over here. So not sure whether or not it will continue to goes up or it will just definitely stop here and decline from this particular junction. Okay, so this is basically how you use Fibonacci retracement, right? Yeah, we already come to the end of the session.